Right, so big pop in early trading, Lyft stock up as much as 23%. It did come down a little bit toward the end of the day, closing about close to 10% higher. So it was a strong start for this ride-hailing company, the first ride-hailing company to go public and setting the stage for the big IPO, of course, of Uber, which is expected later this year, as well as this string of other tech IPOs, among them Pinterest, Slack, Palantir, many of these companies of which we talked about a bit last week. Not profitable, but still very healthy appetite for them from investors as they go public in these markets after waiting for a long time in Silicon Valley to finally set the stage this year.
That jumped out to me too. Who cares about Lyft? Bring on the rest of them now. A big valuation for Uber, for instance, and the rest of the big names that have all been sitting in the private markets without any access. I thought that was quite key. The other big part that jumped out to me on the back of some of the commentary around Lyft and Uber was whether both companies start to change their operating practices. They need to grow up when they come to markets, and despite all the red ink they've been posting, whether they might have to try and stem the tide by lifting prices for customers.
There was a huge focus on the future and path towards profitability in this company's road to get public on Friday. In the interview with the co-founders with CNBC, they were emphasized that they're taking this long-term view. They said, yes, we understand that we made nearly $1 billion loss last year, but we expect that at some point we will be profitable, and that they pointed out that some of their rides are indeed profitable. They would not break down which of those were versus the market, such as scooters that weren't. But they did say that there's such a huge market in the U.S. with the consumer transportation sector, $1.2 trillion. They're just taking a small slice of that now. And that they think overall this revenue model will shift from ownership to service that allows the path for profitability to open up. They're very optimistic. They seem to admit that investors who bought into Lyft early on in trading agree with that idea as well.
One of the fears that I have after such a stunning day for Lyft is whether the share price can continue to hold these gains, because when you bring another major competitor into the market, then you start to sort of come up against that wall where you have investors. Do they want to be exposed to both parties, or do they want to choose between one or the other? And Uber comes to market with a valuation of at least $100 billion, so that's going to suck some life, you'd think, out of the natural market for ride hailing. What do you think? Where do investors start to look? Is it going to be Lyft or Uber? Because bigger doesn't necessarily mean better as well.
It doesn't, and the reality here is that Uber, as it goes public, $120 billion is the latest estimate for its valuation. That is at the top end of any company right now in the S&P and the NASDAQ. So it's hard to compare that to a Lyft, which at $20 billion, that is an impressive IPO, but it's pretty on par with many other tech companies right now. Uber is a behemoth in this space, and it has the potential to make those acquisitions, as we saw with its acquisition of Careem and the Middle Eastern rival last week. And possibly investors might say, if I'm going to get into this space, I might want to go with the bigger, better option. We've seen that bet play out with many of the other tech giants, from Amazon, Facebook, those big companies seeming to pay off with their stronger returns because they just own so much of the space.
So there are a lot of stags out there who will look at the opportunity of this pop over the first few days, and they will make their money and they will go away. And then there are the longer term investors who might believe in the longer term business model. I would commend them to read John Cassidy's article in the New Yorker magazine about this, where he compares some of the IPOs this time round with Priceline and some of the IPOs back in the dot-com bubble age. And Priceline on its debut had a 330% pop in its share price. 2 years later, it went from over $69 to $2. Priceline survived the dot-com debacle, but we know lots of other tech companies didn't. If Uber's coming to the market and there are other competitors, how do we know that Lyft is the one that survives, or Uber survives, or none of the above?
The only answer to that right now is that those two, Lyft and Uber, are the only two players in the U.S. market. So it has to be one or the other right now. There is no clear competitor, no obvious competitor in the U.S. Certainly internationally, there are some very solid other options. And if those companies go public, Grab, for example, that could present a viable alternative. Right now, it's just this point of, okay, we know that ride-hailing is an important market. This is something that a lot of consumers value. If we want to be invested, it is one of these two companies, at least for right now.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.